are joined by two guests now, Girish Pai, the Head of Research Institutional Equities at Nirmal Bang, and Naveen Mishra, the Senior Director Analyst at Gartner as well. Gentlemen, good afternoon. Thank you so much. Now, this sector is facing a lot of moving parts, right? Right from rupee depreciation to growth concerns, supply side issues, and the commentary, etc., have been a bit mixed as well. We've got you together to understand how to look at this sector. And Girish, let me first come to you because you were the first one to really flag out the headwinds that the sector is facing. And even if I remember it correctly, you were the first to downgrade the sector on 10th April itself. But the question to you is, now after the correction that we have seen, 30% down on the Nifty IT, is the worst priced in?
Isha, thanks for having me on your show. I would not think that it's in the value zone as yet. There are quite a number of people in the market who kind of indicate that the correction has led to a situation where IT stocks have come to value territory. If you look at the TCS PE multiple right now on a forward 12-month basis, it's trading at about one standard deviation above the 5-year mean, and that 5-year mean is actually has a time period when valuations are slightly more elevated. So 5 year mean, it's one standard deviation above that. If you kind of stretch the time period to 15 years, you're probably trading at 2 standard deviations above the 15-year forward mean. So we are not in value territory as yet. If you look at the P multiple charts of all these stocks over a slightly longer term, you will see that it's not in value territory as yet. And my sense is that if I look out into FY24, I think Street is still building an optimistic revenue growth estimates. My peers are building in high single digit to low teen kind of dollar revenue growth into their estimates. I'm in the mid single digit territory, and my sense is that probably even that has got a downside potential. And on the margin front, I'm expecting flattish margins as we speak right now. I think that could potentially undergo change if there is a pushback from a pricing perspective from customers. So right now, vendors are trying to get higher prices, but in the kind of scenario that I envisage into 2023 calendar year, where I think that the US will potentially go into a shallow recession and IT spends are going to be constrained, I do think that there's going to be pushback in terms of pricing. So those are the kind of elements which make me believe that probably there's more downside to the IT stocks.
So that's a very clear bearish view coming in from Girish, that there is perhaps more downside on those counters, and growth as well as margin picture looks a bit murky. But let me come to you, Naveen. You are the one who tracks the IT spends very closely, and Gartner does that very frequent analysis of where they see the spends headed. And if I remember it right, you have recently increased your estimates when it comes to 23. In 2022, you have cut down their estimates, but in 2023, you are expecting the growth momentum to really continue when it comes to the IT spends?
Yes, Nisha, that is correct. And let me peel the onion a bit. Two things. For 2022, we expect the market to witness 3% growth rate, which is lower than what we originally projected to be 4%. Now, from this 4% to 3% reduction is primarily driven by the decline and the tightness that we expect in the consumer side of things, the consumer spending, inflation going up, people trying to preserve their cash, and so on and so forth. And with all of that, our devices spend has been reduced. So that's predominantly the reason why the 4% growth rate has been reduced to 3%. But yes, that 3% does not reflect any major or material decline in the enterprise IT spend, including the IT services company, which I know a lot of you here care about it. So for 2022, 3% growth rate, no reduction in the IT services or overall enterprise IT spending. Now, that's one part. The second part that you mentioned for 2023, yes, we expect about 6.1% growth rate for 2023. And that is actually based on the optimism that a lot of uncertainties in the macro economy, some of that may hopefully ease out, and that will actually add more momentum to the overall spend. So 2022, 3%, 23, 6% IT spend growth.
Okay, so that's the word coming in as sort of where the spends are really headed. But Girish, what are the chances that your assumptions go wrong in terms of the probability of how things stand? Don't you think there is enough negativity built in the price? And if you have a, let's say, 3 to 5 year view, would it be a good entry opportunity for long-term investors?
Yeah, I don't want to comment on the Gartner's numbers. I would kind of look at my base case analysis or base case assumption that you will probably see a shallow recession. I think obviously the street is kind of divided on what kind of macroeconomic outlook it has got vis-a-vis the US toward the second half of 2022 and in 2023. Some are kind of building in a growth recession, some are building in a mild a shallow recession, and some are building in a hard landing. We are in the mild recession kind of territory, so shallow recession kind of territory. That's where we stand. And as I said, the thing to look at is from an enterprise perspective. We are now having a situation where enterprise profitability in the US, S&P 500 profits are at record levels compared to history. They are at about 13-14% of GDP as we speak right now. And we think that that is going to come under pressure pretty significantly towards the latter half of 2022 and in 2023. And that is what's driving our view that there's going to be some pressure on the IT spend overall and on IT services specifically. So we're not saying that IT services spend is going to get cut, but it may probably not grow. $100 will probably remain $100. And within that, the enterprise would want to squeeze more out of a particular vendor, through volume discounts that may ask for. There could be vendor consolidation exercise, which would probably hurt the tier two players a lot more. So that's broadly our construct. We are not structurally bearish in the sector. We think that there is potentially an upside if you take a 3 to 5 view that you kind of talked about. See, that is entirely dependent in our view on how the US Fed behaves. So if you look at the 2008-2009 situation, we saw a very significant quantitative easing that happened. Even in the 2020 COVID situation, there was a significant quantitative easing that happened, which led to a V-shaped recovery, both in terms of earnings and PE multiples for the sector. Now, whether that will get repeated beyond this 2023 kind of down move of the industry that I am talking about, we'll have to wait and see whether the supply side pressures on the inflation front will actually allow Fed to actually reflate the economy. So that's what I'm a little concerned about. We will probably get a pent-up demand-related growth in 2024. But beyond that, will the structural growth of the industry kind of accelerate is the question that we need to kind of ask.
Girish, let's just talk about mid-cap versus large-cap. So in the last 2 years, you've seen mid-cap valuations also coming closer to the large-cap names. Now, even in correction, both have fallen. What is the sense that you get? Do you think that, overall the space could be looking in at better growth for mid-cap, or will it again go to a discount versus large-cap as valuations for large-cap is correcting?
So between mid caps and large caps, see, I think my issue has been that this has been a high tide which lifted all boats, including some of the more weaker ones. And I would probably put tier two in that category. And I think they've benefited from the overflow of work, so to speak, and the fairly tight supply side environment we have right now. But my sense is that going into the kind of spending environment we're going to see in 2023, I think there's going to be vendor consolidation. And I would probably think that tier two vendors are going to be in a worse situation compared to tier one vendors, because one, they will be the victims, or they will be the receiving end of the vendor consolidation, so to speak. I also believe that the enterprises that they kind of cater to, a large percentage of them are beyond the global 1,000 set, and those kind of enterprises will probably see a lot more, pressure in terms of profitability, and therefore their spends could probably come under a lot more pressure. So my issue with tier two is that valuations are rich. I think there is probably greater risk to their revenue and earnings as we go into the 2023 or FY24 situation that we're kind of talking about.
Right. Let's take a view from Gartner as well then on that note. How do you see market share gains for Indian companies in US and Europe versus some of the other space? Every time we've seen a slowdown and then there has been a pickup Indian IT companies have gained market share, especially the mid-cap ones. You think that trend would continue?
Looking at the recent financials that we have received, especially from some of the large companies in India, such as TCS or SCL, they are recording strong performance, though they have challenges in terms of the margins and talent and so on and so forth. So while we try to dissect this issue, I think what's really important, whether it's a mid-sized company or a large one, we need to look at the factors and some of the factors that actually Girish mentioned. And we look at it as supply chain constraints, talent issues, and inflation. And at Gartner, we call this as triple squeeze. Now, in the middle of this triple squeeze, we reached out to the CFOs, some of the large CFOs around the world, almost 200 CFOs, and we asked them, how much will you decrease, increase, or maintain your digital spend? And I think many of you will be surprised to know that almost 2/3 of the CFOs indicated that they will actually increase their digital spend, and only about 6% of the CFOs indicated that they will actually decrease their digital spend to handle the triple squeeze, the pressure that we have been talking about it. So net, while there would be a smaller set of companies and enterprises who will pull back on digital spend, which is actually a big revenue generator for mid-sized services companies or large-sized services companies. So, I mean, the larger customer base is actually going to increase their digital spend. Hence, service providers of any size, if the larger part of their revenue is coming from the digital revenues, then to me, they are well poised for growth in the second half of 2022 as well as in the next year, versus those companies who are still dependent on traditional outsourcing and manpower-driven business models. They are actually going to struggle a lot because, yes, to the point that Girish was mentioning around vendor consolidations and margins and those kind of things, I think those will be the areas which will be worst impacted. So when we try to evaluate these companies, we need to look into what's the share of their digital revenue. Yeah.
So sorry, Naveen, I'm sorry, just for the the sanctity of time, you mentioned that the companies which have digital digital forays are likely to perform better. But can you help us understand, is there any geographical trend that you are spotting? Because recently, when we have been speaking with companies, there has been a bit of a nervousness around what Europe is likely to do, and that cuts are likely to be deeper there, even if US is likely to see a shallow recession. Is that something that you are spotting in your surveys as well?
Well, I will not make a comment about any recession. That's not my job. That's not what Gartner does. But in terms of my conversation with customers in US, I mean, we see serious challenges and uncertainties in many parts of the US and certain parts of Europe, as well as if I look at Australia from APG, those are the certain pockets where we see increased concerns around the economic uncertainties and how that may lead into recession.